Hello and welcome to the Business Debate. I'm Sarah Lockett and today we're talking about risk management. Traditional investment managers are expensive and generally underperform the market. Plus, for retail investors, they're often out of reach with a typical minimum investment of around £800,000. Digital investment management has become a cheaper alternative, but they still tend to formulate clients' risk profiles as conservative or aggressive, which may not be precise enough for some. Well, to discuss a new approach which is gaining popularity, we're joined in the studio by Adam French, co-founder and managing director of the digital investment service Scalable Capital. Adam, welcome to the Business Debate.
Thank you.
Now, what's the difference in the way that you manage risk, dynamic risk management?
In the traditional wealth management industry, what you would typically have is portfolio management done with static weights in portfolios. So, for example, keeping the weights of your asset class allocations, 40% equities, 60% bonds, and reweighting them over time back to those weights. We think about things differently, and you described it as dynamic. That's exactly what we would call it. And what we do is we make a forward-looking risk projection on each of the individual asset classes. And we do this using technology to be able to make a projection on each of the risks in each of the asset classes to try and keep risk in your portfolio constant. And by doing this, we can make sure that your portfolio is constantly in line with your risk tolerance.
So the simulations you describe are pretty data intensive, previously only available to the very big banks. How are you managing to do it?
Yes, the data computational part of it is pretty powerful. And it's really just the advent of cloud computing, which has been able to take this technology and put it in the hands of the retail investor. What you saw previously was investment banks and large retail banks providing these types of solutions to institutional clients who had billions of dollars of money to manage. And it's great to be able to take that type of technology and put it into our risk management system to be able to give it to retail clients.
Now, retail clients, typically they underperform the market by around 3% because they tend to sell too early. So why do we need to manage? Why don't we just all have trackers?
Yeah, that's a good point. And the problem with trackers is that, yes, they're low cost and they're very well diversified, but you actually don't know how much risk is inherently in that tracker at any one time. So there could be times when the market gets very, very volatile and that tracker moves too much and you actually underperform because you want to sell that before it has a chance to recover. So we use ETFs, which are a form of tracker, as part of our portfolio construction process. And we use them because of the benefits that they provide. But they don't provide this risk control element. And that's what we're providing with the way that we manage the portfolio by dynamically adjusting the weights, using these forward-looking simulations to be able to provide this risk management overlay that you wouldn't have just with a tracker.
And don't your clients get worried that because everything is automated, or that's the perception, that computers and algorithms can fail?
So the algorithm forms a large part of our investment process, but it's really one part in a three-step process. So the algorithm is developed by our team of financial engineers and financial experts, which we're really proud about. So the calibration and the construction of that model is done with humans. Then we have the algorithm element, which you mentioned, and that's really a tool to help us to try and construct these optimal portfolios. But that's not the end step. Once we get the data that we need to be able to construct this portfolio, it gets checked by our trading team. So that includes myself and other senior management, and we're able to check and make sure that the numbers that we're seeing coming out of the algorithm make sense. So it's really that harmony between man and machine that produces the optimal outcome.
And you actually put a percentage on what your investors can lose in a given year. Why is that helpful?
So our investors obviously care about performance. And in the markets, the more risk that you have on the table, the more return you can potentially earn over the long run. So we want to both make sure that our clients understand how much risk they have on the table, but also we want to make sure that the periods of time where there's too much risk in the market, where you might potentially get negative returns, then we have the control in place to be able to re-optimize the portfolio to make sure they don't participate. But you're right, it's really this lack of risk control which leads to this underperformance. Everybody always says, sell low and buy high is the main reason why retail clients are performing badly.
Now, you say that returns can't be predicted, but risks can. And why is that? And how does that knowledge help retail investors get better performance?
So the empirical data has really shown us that it's 50-50 if the market's going to go up tomorrow based on what it does today. So if a certain stock goes up today, you have no idea if it's going to be up or down tomorrow. But what you do know is that if the market moves a lot, or this stock moves a lot, that there's a better than 50-50 chance that it's going to move a lot tomorrow. And it's this feature of the market, which is called volatility clustering, which allows us to do the simulations that we need to do to be able to keep the risk in the client's portfolio constant. And that's really the essence of the way that we think about dynamic risk management.
All right, well, on that note, Adam French from Scalable Capital, thank you very much.
And thank you.